Hello everyone, welcome back. In this lesson, we're going to talk about a very important topic in funding rate arbitrage, liquidation risk. This is something every trader must understand clearly, because if liquidation happens, the cost can be very high and your entire arbitrage structure can collapse instantly. So let's begin by understanding what liquidation actually is. Liquidation happens when your margin is no longer enough to cover the unrealized loss of your position. Remember, in funding rate arbitrage, we always use leverage. And once leverage is involved, the exchange requires you to maintain a certain amount of margin at all times. When the market moves against your position and the loss becomes too large, the exchange will forcefully close your trade. This is liquidation. Whenever you open a futures position, the exchange will show you an estimated liquidation price. This number is extremely important because it tells you the exact price level where the exchange will liquidate your position if the market continues to move against you. The liquidation price is closely related to both your leverage and your margin. If you increase your leverage, for example, from 2 times leverage to 20 times leverage, your liquidation price will move closer to your entry. That means even a small price movement can cause liquidation. On the other hand, if you use lower leverage, say from 50 times leverage to 10 times leverage, the liquidation price moves further away and your position becomes much safer. Margin also plays a role. Given that the same leverage level, if you add more margin into your position, the liquidation price moves further away. If you remove margin, the liquidation price moves closer. In other words, your liquidation distance is something you can actually control. Now, in funding rate arbitrage, our number one objective is to avoid liquidation. Not only because it destroys your arbitrage structure, but also because the exchange will charge a liquidation fee, sometimes around 0.5%, or even up to 3% of your entire position. This is money you absolutely do not want to lose. So the best way to avoid liquidation is to set a stop loss before the liquidation price. Let me give you an example. Imagine you open a long position at 1 USDT. Your estimated liquidation price is 0.50. To avoid liquidation, you should not place your stop loss exactly at 0.50. Instead, place it slightly above, maybe around 0.55. If the price drops to 0.55, your stop loss will submit a market order and close your position safely. But if you don't leave enough distance and the price drops too quickly, the stop loss might not trigger in time and you could still get liquidated. That's why I recommend keeping a buffer of about 0.5% above or below the liquidation price, depending on whether you are long or short. There's one more important concept I want to share with you, and that is the ideal distance between your stop loss and take profit levels and the current market price. In funding rate arbitrage, we are not trying to predict the market. We don't care whether the price goes up or goes down. Our only goal is to stay delta neutral and to avoid liquidation on both sides. And because of that, your stop loss and your take profit should always be placed at even symmetrical distances from the current market price. Why is this so important? Because a balanced setup protects you no matter which direction the market moves. If the price suddenly spikes upward, your short position will close safely. If the price suddenly drops, your long position will close safely. By keeping both exit points equally spaced, you are not betting on market direction. You are simply defending your positions. This symmetrical approach ensures that whether the market rises or falls, you avoid liquidation, you exit cleanly, and you remain fully in control of your arbitrage strategy. It is the safest and most neutral way to protect your funding rate arbitrage positions. And later in the advanced lessons, I will show you what to do when the price starts approaching your stop loss or take profit level, including how to adjust your margin and extend the life of your arbitrage position, so you can continue collecting funding income for much longer. Apart from sudden price spikes or flash crashes, there's another source of liquidation risk, and that is human error. In later lessons, I will teach you how to maintain your arbitrage position by adjusting margin. But here's the thing. Whenever you change margin, your liquidation price will change too. If you forget to update your stop loss and take profit on both exchanges after adjusting the margin, you may end up with one leg closing while the other leg remains open. This breaks your delta neutral structure, and if the price continues to move, the remaining leg can quickly lose money. So please remember, every time you adjust your margin, you must also adjust your stop loss and take profit levels on both exchanges. This is critical for safety. I hope this lesson helps you understand liquidation risk more clearly. If you set your stop loss properly with enough buffer, liquidation is actually a fully manageable risk. In a future lesson, I will teach you how to position your liquidation price at a safe distance from the market, so your arbitrage can stay open for a longer period without being stopped out. See you in the next lesson.